Since putting in a high on June 8th, crude oil prices have decreased 27%. In the same time period, the Canadian dollar is down 3% against the U.S. dollar, and as of May of this year, it appears that the crude oil and the Canadian dollar have resumed their historic directional correlation.
Earlier in the year, that correlation broke down as both crude oil and the U.S. dollar spiked sharply in the wake of the Ukrainian conflict. Now, in recent days, we've seen data out of Canada that suggests inflation may have peaked, with a 7.6% read in July, down from a June year-over-year of 8.1%. Now, to be fair, we've seen a similar pattern in the U.S., as domestic inflation moderated in July reading as well. The question traders ask is if both the Bank of Canada and the Federal Reserve have shown similar resolve in fighting inflation, could that possibly leave the currency pair to trade more heavily on traditional fundamentals like its oil price correlation? Now, CME Group offers 3 different size currency contracts, the standard, the mini, and the micro, in order to match a trader up with their preferred risk tolerance. We're going to be using the micros in these examples. If a trader believes that the Canadian dollar could head lower from here, perhaps dragged down by current weakness in crude, they could express that by selling the September micro Canadian dollar futures contract at spot 7736 and target a move to the July lows of spot 7565. A stop for this trade could be placed above at spot 7810. This trade could make $171 if your target is reached and risk 74 if you're stopped out of your level. Now, if a trader believes that the Canadian dollar could rally from here, they could express that by buying that September micro Canadian dollar futures contract at spot 7736 and target a return to the June highs of spot 7970. A stop for this trade could be placed below at spot 7620. This trade could make $234 if your target is reached and risks $116 if you're stopped out at your level.